Welcome to Spinoff Investing Simplified's series on spinoff investors. Today we're talking again with Rich Howe. We're really grateful to have you here. Thanks a bunch, Rich.
Of course, yeah, good to be here.
All right, let's go ahead and talk. We promised our group last week that we would talk about journals, but before we jump into that, this last week was a really interesting week because you had a bunch of market volatility based on the coronavirus. So just a quick takeaway, what do you think our investors should know about the coronavirus as they go through this week?
Yeah, so I know we talked a little bit about this offline. First of all, a caveat: I'm not an expert by any means, but my sense is that that it's an issue that we're gonna be able to get through. It's a disease that is extremely contagious, so I just think it's a matter of when, not if, it really expands in the U.S. At the same time, the mortality rate, the estimates don't seem incredibly high. I know the mortality rates for the elderly population is a lot worse than younger people, a more healthy population. So I think steps definitely have to be taken to care for and quarantine the elderly. But I think it's a thing that I think in 3 to 6 months we'll have gotten through this. And from a health perspective, I do think that the economic impact is going to be, you're already seeing it with a lot of companies, cutting guidance or pulling back guidance, having a lot of supply chain, issues. I think there's a real possibility that this is kind of the final straw that pushes us, U.S. and the world markets, more generally speaking, into a recession. But at the same time, there looks to be a lot of really interesting stocks. I know a lot of leisure and travel stocks are getting whacked. Madison Square Garden, Live Nation, I think those stocks look interesting. Wyndham Hotels, I'm looking at that one too. So, from my perspective, I think we'll be able to manage the health crisis. But I think it's more likely than not that this ends up tipping us into a recession. I don't know. What do you think?
I'm thinking the same thing. But I think I got to thinking about it after we had our discussion prior, and now this one right here. I think a lot of CEOs are going to seize the opportunity to excuse themselves from maybe some poor results over the next couple of months, maybe even the first half of the year. And so we might see that with a lot of them. I'm the same way with you. I'm looking for opportunities, and I'm looking at, like we discussed offline, Garrett Motion is one of the companies that I'm looking at because they have one of their plants in Wuhan where everything started. With the quarantines and everything, they're making it so that it'll be a lot more difficult to make some of their numbers. So I guess we got a rocky way ahead of us for the next couple of months. So it'll be interesting. So, all right. Well, we promised our readers last week, or our listeners and watchers last week, that we would talk about investment journals. First and foremost, Rich, do you have an investment journal?
Yeah, so I do. So I wouldn't say, I don't have like a leather-bound journal that I write in, although I found that that's, many people find that helpful. I tend to take notes just on like Google Documents. So I'll have a watch list of stocks that I'm looking at. I'll jot down basically the basic investment thesis, and then I'll be able to basically refer back to that watch list. The other thing that I do is, as you know, I started running Stock Spinoff Investing as a blog in 2016. And so basically that's kind of my journal, because I'm just putting out basically my highest conviction ideas, what I'm thinking, my best investment ideas. When things don't go wrong, I can go back and review my original investment case and learn from mistakes that I made, whether it was underestimating certain risks or not appreciating certain other things. So that's really what I use as my journal. How about you? Do you actually keep an investment journal?
Yeah, I actually brought it today. So I do more than just journal about investing, but I have just a regular spiral notebook. It's probably you know, it's $1.50 or whatever I spent on it. And I have a couple of things that I journal in it, but one of the things that I do journal is my investments. I like to do a weekly journal on the things that I'm doing and what I'm thinking, and then I like to use that as a way to pause before I jump. That's usually the biggest thing for me is I'm one of those people that I'll just swing for the fences every single time, and I don't
Mm-hmm.
want to do that. I want to cage my mind so that I
Right.
do it at the right time and for the right
Mm-hmm.
reasons. So anyway, um, your blog, I really like the stock spinoff uh, investment theses that you put on that, and it's interesting to read some of those things and look back to your thoughts. Even for the ones, to me, I'm always wanting to look back at my failures and identify,
Mm-hmm.
okay, what did I make mistakes on? And it's just interesting to look back at someone else's perspective on that as well. So,
To look at my failures.
well, hey,
Way more
I like
interesting
the
to look
fact that
at your own.
we both make failures.
Exactly. No, I know. Yeah, so one stock that I invested in that I've actually written up. So if you Google stock spinoff investing Quorum Health, it's basically a rural healthcare company that was a spinoff and looked extremely cheap based on management's guidance, based on the slide deck that they published. And they had, I forget the specifics, but it was a pretty highly levered company. But remember, Joel Greenblatt says that that's not necessarily, the worst thing in the world. You can accrue really big returns to the equity side if the business grows and it's undervalued and it re-rates. And I kind of took the guidance, the EBITDA guidance at face value. And that was a really painful mistake. The stock, basically the first quarter that they fully reported, they basically took down guidance completely, almost cut it in half. And the stock basically got cut in half. I basically reevaluated my thesis and, decided that even though the stock was 50% cheaper than I had, originally invested in, that it was a sell and I should just sell it and take my losses. And because, it's hard to do, but you try to take an objective look and say, like, listen, here's what I thought they would earn. Here's what peers are trading at. Does this stock still look compelling? And it didn't, just based on that guidance cut. And then you also just have management credibility that's goes right out the window. But the main lesson for me for that one was basically you need to verify. So you really need to verify guidance. You can't base an investment thesis, and this may seem super obvious, but you just can't base an investment thesis around guidance. You need to ensure that the person or the management team that's running the spinoff was running it before, that they're deeply familiar with the business, and that they've signed off on those numbers. Because what happened was Quorum Health, the parent company, basically said, hey, here's what Quorum Health is going to earn next year. And then they brought in a management team, said, hey, here's your company. And that company really hadn't signed off on that guidance. And if you read back through the analyst day, you can kind of suss that out a little bit. And so that was a big lesson learned, that really verify basically on just kind of securities analysis, what the run rate earnings power of the business is. Don't just take management's word for guidance. And then the other big issue was their interest. The interest on their debt was like over 10%, and it's just a red flag. If a company has, no matter what their interest rate is or what their debt to EBITDA ratio is, if the bondholders want to get paid over 10%, then that just gives you some insight into the defensibility and the quality of the business vis-a-vis the bondholders, who tend to be more focused on the downside. So I'd say I have more of an appreciation. And then conversely, like Garrett, I remember when Garrett came out and issued their debt. I think their debt, their weighted average cost of debt, this could be wrong by 50 basis points or so, but I think it was like 350 basis points. And that was just impressive to me, that here's this business that I thought was super cyclical, and it's amazing that the debt holders, were comfortable basically giving a good amount of debt to Garrett, at such a low interest rate.
Yeah. Going along with Garrett, that's been one that I've spent a lot of time writing about in my journal just to remind myself where I'm at.
Mm-hmm.
And I spent a lot of time doing some studying on its return on capital.
Mm-hmm.
I don't know if you use that ratio at all when you're analyzing stocks, but for me, I like to look at the return on capital and then the yield on
Mm-hmm.
on the investment when I purchase it. And the return on capital is what keeps me okay. Eventually, something's going to turn around just because there's just such a high return on capital. I can't. I think I have it in here. Let's see if I can find it real quick. It is. It was well over 20%, which, yeah, 2021 is kind of what I'm guessing it will come out to be.
Yep.
But again, that's a calculation that requires a little bit of it requires a little bit of judgment on my part,
Mm-hmm.
and I
Mm-hmm.
have to identify, okay, what do I really expect that to be?
Yep.
And man, if I could find companies that always had 20% return on capital, that'd be stuff that I'd be really interested. That's actually something that you brought up when you were talking about American outdoor brands,
Mm-hmm.
and I did my analysis on them. I checked their return on capital, and it was dropping like crazy over the past couple of years, and rightly so, with the cost of inventory and things that are going up in that
Mm-hmm.
company. It's been some interesting things that have happened, but Ruger, their main competitor, always has maintained a return on capital of 15% or more, even during those downturns. And
Mm-hmm.
so to me, that's just like you, it's kind of a play on the political environment. You know, will they have that opportunity in the future? And if they have that return on capital, that means it's a good business. Anyway, sorry, go ahead. So,
Yeah, no, I agree. Yeah, with Garrett, yeah, Garrett surprisingly, I mean, you think of it as an auto supplier, you think of it as a really high capital intensity business, but it's really not. Yeah, I mean, Garrett is so interesting. It's a really good business, high quality business, trading at a very cheap valuation. It is cyclical, so if we enter global recession, revenue and EBITDA will definitely fall, but at the same time, it'll emerge. You also have the increased turbo penetration. Obviously, Garrett makes turbochargers, and turbochargers make cars more efficient. So, to minimize emissions, you're going to continue to see increased penetration of turbochargers. But then the long term risk is that Tesla and electric cars take over the world, and so internal combustion engines, are no more. And I mean, I think eventually in the long term, I think that's probably right. But I think there's going to be a long tail. And I think it's, Garrett's going to have a very good business for a long time until Tesla takes over the world. So yeah, it's definitely an interesting one. That was one that I went into thinking like, this is just crap. You have the asbestos liability, you have the heavy debt load, you have the cyclicality of the business. But then you dig in, you're like, okay, this is actually a pretty high quality business. They generate good cash flow, relatively low capital intensity, and it's only gotten cheaper, so only looks more attractive.
who knows? Who knows? Yeah. An interesting thing about that, I'm curious what your thoughts are on the Tesla thing, because that's been another thing that I've spent some time writing in my journal about. To me, I don't buy the fact that Tesla is going to be the next big auto industry, disruptor. I really think that they got their market, and my concern is until the infrastructure is there, they're not going to replace that. But that comes from a guy that lives in Idaho in a podunk town that I know we have like 4 chargers in the entire
Yeah.
town for Teslas.
Yep.
So that's a totally different perspective than most people, I'm sure. So
Yeah, no, I mean, there's going to be a huge investment from building out kind of the charging infrastructure. So it's going to be, yeah, it's going to take a massive investment. Whether it's Tesla, I mean, I think other car companies are going to contribute as well. I think longer term, electric vehicles are going to take more and more share. just because they're viewed as more environmentally friendly. I mean, they are more environmentally friendly, even though, to burn electricity, you need to generate that from something. Natural gas is cleaner than oil, but it's still, it's still carbon, a fossil fuel. So yeah, I agree with you there.
Yeah, my concern with the environmental side of Tesla is the use of lithium, and I don't know if we really have a solution for the lithium battery, recycling process or anything like
Yep.
that. And I think that yes, it's green right now, but I'm afraid that one day electric vehicles and electric powered things in general, people will be like, okay, how do we dispose of this? Because lithium has a much bigger effect on the environment than a lot of people are really realizing. So who knows?
Yeah.
Who knows?
No, that's interesting.
So
So let's get back to journaling. So
okay, sorry.
tell me more about how you use your journal. So say you're excited about a stock. Because one thing that I like to do is I obviously publish full investment cases for all my ideas, and that helps temper my over enthusiasm. But how do you use your journal? Like say you see a stock that you really like, what's your process for journaling about it? How do you use it to kind of temper your, I don't know, more, I guess, emotional impulses?
Yeah, so I didn't do this always, but I've been getting into the habit of before I buy, I have to
Mm-hmm.
write a full thesis in my journal, and then I wait until the next day. And
Mm-hmm.
that's probably the biggest thing that helps me, just because a lot of times we get all excited about something and we have to buy it right away. And when you delay your gratification, that gives you an opportunity to change. And that actually changed the way that I started purchasing things. You've read some of my emails probably, and
Mm-hmm.
I purchase by selling puts on the companies
Mm-hmm.
that I'm interested in.
Mm-hmm.
And I mean, that takes out some of the companies that you can purchase. Not all of them have options on them, but I like to do that. And I like to do it in a way like right now, I'm selling puts on KLXE.
Mm-hmm.
And, and the reason why is because I just feel like it's dirt cheap. And right now I can sell a put on that company for about a third of the price and of the entire stock. And right now I've identified that it's going to be worth much more. And so I just have to identify, okay, what's the upside to downside ratio for that put?
Mm-hmm.
Am I willing to accept that price? And is that the price that I want to do it? And then I write out my thoughts. And then before I go in and I purchase, I've spent my time looking at that.
And you wait a day. So you're like, okay, I
Yeah.
like this. Here's my thesis. Now, do you publish it on your site, or is it just kind of your personal
It's
thesis?
it's personal. So this is something I've been thinking about. I might start publishing it on my site just
Mm-hmm.
because I need to keep myself honest. And even if you write it in your journal, you can kind of, sweep things under the rug if you don't have it out there for people to read and
Mm-hmm.
give you feedback. Because the best thing about the internet, at least, is that it gives you automatic feedback, and usually from people that are really smart that will tell you, no, you're being really dumb. So
Yep.
but yeah, that's kind of my thoughts. It's interesting that you asked that, because it's been something that's been on my mind for about a month and a half now.
Yeah.
Hey, do I want to start publishing these thoughts and these ideas? Who knows? Maybe I'll make it a subscription process or something. I don't know.
Yeah, I highly recommend keeping an investment journal to keep your thoughts, to be able to check back. I also highly recommend starting a blog for anybody out there. There are a lot of people. I mean, I started a blog in 2016, and it's grown into my business, which has been awesome. It's enabled me to basically quit my job and do this full time. But I know there are a lot of other people who have started blogs and then just gotten hired by funds to become analysts. So especially if you're somebody who's just really interested in the stock market, but you don't have the formal pedigree, quote unquote, it's a great way to get noticed. I mean, Michael Berry, right? He's the poster example of from The Big Short, right? He shorted all the subprime crap and made a fortune. And he basically was publishing on kind of in chat forums and on his own blog and got discovered that way. But I've also seen several other investors basically start publishing online. And then, you focus on a certain niche, whatever that is, whether it's spinoffs or special situations or bank thrifts or micro caps or whatever. And then you tend to attract other like-minded investors, and it enables you to talk and meet and learn a ton from some great people. And then also it can, enable you to maybe launch a fund at some point, get a job at a firm where you want to work, or, start some sort of business. So yeah, I couldn't recommend it high enough. It also, it's funny when you're writing something for yourself, it's funny, but there's a higher bar when you put it out on the internet. Even though it's a bunch of people that you don't know, it's like they're holding you accountable. So you're like, oh, I don't want to put out something stupid. Like I need to double check this risk. Maybe you would have let that slip if you had just kept it in your own journal internally. So it's something that I definitely highly recommend.
Yeah. I'll tell you the things that I put out on Seeking Alpha are the same thing. I like to make sure that it is that, a more refined version of what I've written in my journal. And that's been for the best, because one, it helps me improve my argument, or two, I don't know, make it so that my argument is, I recognize some of the holes in the argument.
Totally. And you can address them, right? Say, hey, here's the bear case. Here's why I think I'm, it is a risk, but here's why I'm comfortable with it. Yeah, totally agree.
So, did you, what did you do before you started your blog then? Did you put out any type of investment journals on your own? I mean, what was your thought?
You know what? I think I did. I started my career at Eaton Vance doing equity research. So I was there for almost 7 years. Did my CFA. Learned from a lot of smart people. We were mainly focused on large cap stocks, and then after that, I worked in private equity research. But this whole time, I'd obviously managed my own personal account, investing in spinoffs and other special situations and small caps and sometimes big caps. But I found that put it this way, my returns have improved a ton since I started publishing my blog. And I just think it's because you have to be a lot more deliberate. Like it's a form, I don't know if you've heard of deliberate practice, the concept that you need to basically spend 10,000 hours refining your craft to become a true expert at it. But it just can't be 10,000 hours of just quote unquote practicing, of just investing. Like you need to be deliberately doing work, analyzing how you're wrong, basically practicing in a way that's difficult. And for me, like writing a blog is like an investing equivalent of deliberate practice, because it forces you to think through the things you could be missing. You get feedback immediately, which is really important. And getting back to, whether I kept a journal, like I'm sure I kept kind of notes about stocks that I liked. What I would find was when the stock market didn't do well, or my picks didn't do as well, I'd kind of forget about the stocks in my PA and kind of, move on. And then the market would pick up again, and I'd get re-engaged in what I was doing. So for me, it helped me kind of stay more consistent and be a little bit more, deliberate about what I was investing in, and then really seeing it through to the end, but also, learning from the mistakes, that you make. So, yeah, it's definitely improved my process a lot.
Yeah. So I think if I was going to look at takeaways for our listeners or viewers, the things that they should be looking for, and I agree with you, is one, you want to have something that allows you to have consistency. And the consistency when you are investing is the most important thing that you can work on. And then the second one is if you can get some sort of feedback or feedback loop of some sort automatically put into this, which is why doing something online is such a great way to do it. And then finally, a way to to really analyze mistakes. And I mean, it's a zero. To me, it's better to analyze mistakes and identify what went wrong than it is to analyze, oh yeah, these are my winners, and focus on the winners, because everyone and their dog will focus on the winners. But if you can focus on the mistakes and identify why it went wrong, that's going to be the best. You're going to get the best outcomes from that. So anyway.
Yeah, totally agree. And then the other thing is, I think you said you have a pretty concentrated portfolio.
Yeah.
Is that right? Yeah. So I do too. And I think that's also important. So like if you were going to start investing, don't buy 20 stocks, or like, and if you're invested in the market, maybe put 80% of your money in ETFs that give you broad-based diversification. But if you're just starting to invest, maybe invest in 5 companies. With that remaining 10 or 20% of your capital, invest in 5 companies. And so that you really feel it when things go well or when things go poorly. Because that's another thing. If you own like 50 names, it's kind of like, first of all, how do you keep track of them? How do you really feel like you know them inside and out? And then you don't really feel the benefit when things go well, or feel the pain when things go poorly. I know it's a totally personal thing, but I'm definitely of the belief that it's better to run, a more concentrated portfolio. And then of course, many of the most successful investors have done that as well.
Yeah, along those lines, I agree with you. You want to be able to feel the pain so that you have to pay attention to it.
Yeah.
But the other thing that I like is what Joel Greenblatt said. He said, if you have 5 to 10 stocks, that's all you really need, and you just need to know them really well. And that again forces you, and this is where I spend my time just writing and writing and writing. It forces you to identify what the holes in your thought processes are.
Mm-hmm.
And if I was somebody that was getting into this, I think I would actually start with one stock. I wouldn't put all my money into it. I'd put maybe 5% into it of what I have overall, and I would make sure that I know that company in and out. And if it was just that one company, I'd be okay with it. And I focus on it, kind of like the Warren Buffett, Charlie Munger idea, where I'm a business owner. I'm not necessarily just somebody that's going to buy the paper and then
Totally
leave in 6 months.
Yep.
So
yeah, no, totally agree.
Yeah. Well, excellent. Well, Rich, thanks for coming over and talking with us this week. And I sure appreciate you spending your time and working with me on this. So thank you.
Yeah, I enjoyed it, Greg. Look forward to the next one.
All right. Awesome. Well, thank you everybody for coming by to Spinoff Investing Simplified's online YouTube channel about spinoff investors. Thanks again to Rich Howe for joining us from Stock Spinoff. Help me out. Sorry, Rich.
Spinoffinvesting.com. A lot of S's.
Yeah, too many S's in this. Feel free to go check him out. Full disclosure, I am a subscriber to Rich's paid service. I really appreciate his inputs and stuff like that. Full disclosure for us, or for you, those of you that are watching, none of these stocks that we've talked about are our recommendation for you. If you want to invest in them, we recommend that you do your own research and understand that the risks before you commit any funds. And we appreciate your time, and thanks a bunch. So.